Hello, everybody. It's Josh again from Investing with Humans. Today, we are going to talk about what are options. An option is a contract giving the buyer the right but not the obligation to buy or sell the underlying asset at a specific price on or before a certain date. So, in the stock market, an option is a contract that lets people buy or sell, a certain stock uh, at a specific price on or before a certain date. Now, there's two different kinds of options. There are call options and put options. Call options give the buyer the right to buy assets at an agreed upon price or, on or before a certain date. And put options give the buyer the right to sell assets at that price or, on a certain date. And then you can buy an option or you can be the one selling the option. When you buy an option, it'll cost you a debit, which is a premium, and whenever you sell an option, you will get a credit, which is the premium, that same premium that the buyer pays. It gets paid to the seller, minus any fees that your brokerage might have. There's a few details, each option has. In the stock market, each represents a certain underlying stock, and each one represents 100 shares of that stock. Each one has a strike price that the buyer and seller agreed upon, and they all have an expiration, and they're all worth a certain premium. And then options can be in the money, out of the money, or at the money. In the money for a call option, for instance, would mean that the strike price of that contract is below the current price of the stock. So the buyer of the option could buy those shares at that strike price, which is lower than the current price, and they would be getting them at a discount to the current price. And an out of the money option for calls, let's say, would mean that the strike price is above the current price. So the buyer of the call wouldn't want to exercise that contract because the current price is, less than what they would be buying the stock at. And then at the money is where the strike price is at or very close to the actual current price of that underlying asset. We'll go more in depth than that in a different video, and I'll have some kind of animation thing to make it a little more understandable. And then there's the Greeks, and those are, they kind of determine the price movement of the option as it relates to the movement in the price of the underlying asset, and theta, which theta is the time decay. So the farther away from the expiration, the more the premium is going to be worth, then it would be closer to expiration if the prices of everything else stayed the same, or the numbers did. Alright, and I believe that's enough for this video. We will go into more depth and go over more things in options and investing in general in more videos to come. If you like the content, please subscribe, because it would really help out with the channel, and it would really help me get this information to people out there who don't yet have it, or really need it, which is everybody, because everybody should be investing. You don't want to work the rest of your life if you don't have to, and being financially literate can help make that a possibility. Alright, see you next time.